Hello and welcome back to Invest Smartly. Today we're going to talk about a topic that many investors dread, losing money in the stock market. Whether you're new to investing or a seasoned trader, experiencing losses can be frustrating and disheartening. But fear not, as we're here to shed light on some common reasons why investors may be losing money in the stock market. The stock market can be volatile, and understanding the pitfalls is crucial. In this video, we'll explore the top 5 reasons investors often find themselves in the red. From emotional decision-making to lack of research, we'll cover it all. So, grab a pen and paper and let's dive into the world of smart investing. Stay tuned and let's get started. Reason 1. Lack of research. One of the primary reasons investors lose money in the stock market is due to a lack of thorough research. Many people jump into investing without taking the time to understand what they are getting into. Investing blindly in a company without understanding its fundamentals, market trends, and the overall economic environment can be a recipe for disaster. Ignoring the competition and not being aware of the market dynamics can lead to poor decision-making and ultimately financial losses. It's not just about picking a stock, it's about understanding the entire ecosystem in which that stock operates. Many investors fail to dive deep into a company's financial health, such as its revenue, profit margins, and debt levels. These are critical indicators of a company's performance and potential for growth. They often overlook critical factors like market conditions, industry performance, and economic indicators. These elements can significantly impact a company's stock price and overall market performance. Without this essential information, making informed investment decisions becomes nearly impossible. Attending seminars and workshops can provide valuable insights and help you stay updated with the latest market trends. Additionally, relying on tips from friends or social media without verifying the information can be detrimental. It's easy to get swayed by popular opinion, but that doesn't always translate to sound investment advice. To avoid these pitfalls, it's crucial to conduct comprehensive research and stay informed about the market. This means regularly reading financial news, using stock analysis tools, and keeping an eye on market trends. Educating yourself and seeking professional advice can significantly improve your chances of success in the stock market. Taking online courses, reading books, and consulting with financial advisors can provide you with the knowledge and confidence needed to make better investment decisions. Reason 2. Emotional investing. Another common pitfall for investors is letting emotions dictate their investment decisions. This often happens when investors react to short-term market movements without considering their long-term goals. Fear, greed, and impulsive reactions to market fluctuations can cloud judgment and lead to hasty buying or selling actions. These emotional responses can be triggered by news headlines, social media, or even conversations with friends and family. It's essential to remain disciplined and rational when making investment choices. Taking a step back to analyze the situation objectively can help in making more informed decisions. Emotional investing often leads to buying high and selling low, which is a recipe for losses. This behavior is driven by the fear of missing out during market highs and the panic of losing money during market lows. For instance, during market downturns, fear can drive investors to sell off assets at a loss, missing out on potential recoveries. This panic selling can be detrimental to long-term financial health. Conversely, during market booms, greed can push investors to buy overvalued stocks, leading to significant losses when the bubble bursts. This overconfidence can result in poor investment choices. To avoid these pitfalls, it's crucial to have a well-thought-out investment strategy and stick to it, regardless of market conditions. This strategy should be based on thorough research and a clear understanding of one's financial goals. Remember, successful investing requires patience, discipline, and a clear mind. By staying focused on long-term objectives and avoiding emotional reactions, investors can navigate the market more effectively and achieve better results. Reason 3. Overleveraging. Leverage can amplify gains in the stock market, allowing investors to potentially see significant returns on their investments. However, it can also magnify losses, turning what could have been a minor setback into a major financial blow. Overleveraging, or using borrowed funds to invest, is a double-edged sword. It can expose investors to significant risks, including the possibility of losing more money than they initially invested. This can lead to potential financial ruin if the market moves against them, wiping out their investments and leaving them in debt. It's crucial to manage leverage carefully and understand the risks involved. Only use leverage when you are confident in your investment strategy and have a clear plan in place. One of the biggest risks of overleveraging is receiving a margin call, which can be a devastating event for any investor. A margin call forces you to sell assets at a loss to cover the borrowed funds, often at the worst possible time. This can lead to a downward spiral of losses, as selling assets at a loss can further deplete your investment portfolio. Therefore, it's essential to have a solid risk management plan in place to protect yourself from such scenarios. Diversification can help mitigate some of the risks associated with leverage by spreading investments across different assets and sectors. This way, if one investment performs poorly, others may perform well, balancing out the overall risk. Additionally, having a long-term investment strategy can provide a buffer against short-term market volatility, allowing you to ride out market fluctuations. Setting clear financial goals and understanding your risk tolerance are key steps in managing leverage effectively. Knowing how much risk you are willing to take on can help you make more informed decisions about using leverage. Remember, leverage is a powerful tool, but it must be used wisely to avoid financial pitfalls and achieve your investment goals. Reason 4: market volatility. Stock markets are inherently volatile, with prices fluctuating daily based on a myriad of factors. Sudden market downturns or unexpected events can lead to sharp declines in stock prices, causing investors to incur losses. It's important to diversify your portfolio and be prepared for market volatility. Historical data shows that market crashes, like the 2008 financial crisis, can have long-lasting impacts. However, markets also tend to recover over time, following cyclical patterns. By maintaining a long-term perspective and employing risk management strategies, investors can better navigate volatility. Diversification helps spread risk across different asset classes, reducing the impact of any single market event. Ultimately, understanding and preparing for market volatility is key to successful investing. Reason 5: lack of risk management. Effective risk management is key to successful investing. Without it, even the best investment strategies can fail. Failure to set stop-loss orders, establish risk tolerance levels, or implement a proper asset allocation strategy can leave investors vulnerable to significant losses. Diversification is a fundamental risk management strategy. By spreading investments across various asset classes, investors can reduce the impact of a poor-performing asset. It's essential to protect your capital and minimize risks to preserve your investment portfolio. Regularly reviewing and adjusting your risk management strategies can help ensure long-term success. Remember, the goal is not to eliminate risk entirely, but to manage it effectively to achieve your financial objectives.